Okay, we are live. Welcome everyone. My name is David Kosmider. I am the creator of TimingResearch.com. This is our show for October 27th, 2014. Today we will be discussing the 57th weekly report from Timing Research. And if you have not had a chance to look at this yet, just go to TimingResearch.com/reports. For all of you who are new to Timing Research, we are building a crowdsourced sentiment indicator. Every week, I send a quick 5-question survey to all subscribers, and then based on that data, I compile a weekly report and publish it on Sunday afternoons. So, to discuss this week's report, I have two guests with me here today: Greg Weitzman of TradingZone.com and Todd Gordon of TradingAnalysis.com. And Greg, let's start with you. If you could tell everyone a little bit about yourself.
Sure. Hi, thanks for having me again, David. Good to be here as always. Let me just turn off the dripping sound from the cellular phone. There we go. Okay. So I'm Greg Weitzman from the TradingZone.com. I've been active in the trading futures commodity markets since roughly 1994. Been a trading educator since 2003. Spend most of my time, working with active commodity traders at the TradingZone.com, running a live daily chat room. Most of what we do, almost everything that we do actually, is based on technical indicators for the aggressive day trader. We also do some swing trading, stuff like that, but most of our approach is based on market flow, energy of the markets on an intraday basis. And that's a little bit about myself. I don't want to bore you too much with lengthy history of what I've been doing.
All right, sounds good. Yeah, thanks for being on again. And Todd, if you could tell everyone a little bit about yourself.
Sure. Thanks, guys, for having me. Pleasure. So I'm Todd Gordon, and founder of TradingAnalysis.com. We are a research and trade signal business. We focus in the 4 major macro asset classes, so stocks, fixed income, commodities, currencies. We do a hybrid of technical analysis for execution with a fundamental backdrop. Also keep an eye on intermarket kind of correlations. So we are a online research portal with trade signals sent out via text, email within our members area. Prior to that, I traded for a hedge fund, Gain Capital. I've been on CNBC maybe 300 to 400 times over the last 5 years on the show Money in Motion, and I was on Thursday, Friday, which, Greg, it might have been a hard time for us to connect ahead of time. So yeah, I've been around the business. Started trading when I was 18, which is now half of my life. So it's all I've ever done, all I ever know, and thank God volatility's back, right?
Right. Amen to the volatility.
Yeah. Well, we're now back in the range, so we'll see if we can get back out of that summer range. But anyways, no, markets are moving.
All right. Yeah, sounds good. Thanks for being here. So let's move on to the report. And I have activated the Q&A app for this Hangout, so if anyone watching has questions, just type them in, and we'll get to them at the end of the show. I'm going to share my screen now to the report itself. Okay, so question 1 of the report, or page 1 of the report each week, covers the multiple choice questions from the survey. So question 2 is based on any technical or fundamental indicators that you want to use. Would you guess that the S&P 500 index will move higher or lower next week from Monday's open to Friday's close? And this is actually the strongest bullish sentiment I've seen since I started doing this in the full 57 weeks of the that I've been doing this report. So 72.3% guessed higher or predicted higher for this week, and like I said, that's the highest I've ever seen so far. 27.7 guessed lower, And so, Greg, let's start with you. What would your prediction for this week be?
Yeah, I think early in the week we're going to see a nice little bounce. I don't think it's going to be sustainable. I think what we're seeing right now is pretty much a classic scenario of the institutional versus the retail traders. And what I mean by that is, you talk about indicators or things that I would use to gauge this market. Watching the VIX, the volatility index, which has been sandwiched between a low of 10 and a high of about 16 for the past 12 to 15 months, the market has been showing a huge lack of volatility, complacency, which is a clear sign that the retail traders are buying into the highs. And we've seen this over and over again over the past decades. What we saw last week was this tremendous spike in the VIX up to about 31. Causes a little bit of panic, and the first people who run for the exits again tend to be the retail traders. The small, long-term buy and hold investors. And as soon as the market gets a little bit shaky, they tend to exit quickly, predominantly because they buy near the highs. And the institutions that are more or less contra trend thinkers look at this as a tremendous buying opportunity. So I think that's what we're going to see in this next week, is we're going to see this volatility crush, which we've basically seen over the last 4 days, with the VIX moving back down to its kind of natural habitat in that 16 to 18 range, which is still a little bit artificially low. But it's this, evaporation of that volatility spike. So we saw the VIX up at 31, then we saw it retreat. The VIX, for those who are unfamiliar, is a measure of market volatility calculated by the value of the premium paid on puts and calls. So it's really taken from trader sentiment as they bid up the price of the market options, and it's a great indicator to measure that, because it compares actual volatility with implied volatility. So the implied volatility is the intention of the traders, and they'll bid up the VIX, or they'll send it back down. What's so interesting is that it's kind of the classic mistake scenario of retail investors, which is, right now we have a short-term buying opportunity. The institutions are going to run in and take advantage of this. They're going to be buying it up, setting the market to retest prior levels. Technicians will look at that as double tops, perhaps, and the retailer panicked and got out. And now, as it starts to creep back up towards the highs, based on the institutional buying, the retailer is going to get sucked back in, continue to buy at the highs, and then I think in about a week's time, maybe a little bit further out, we're going to see a more material sell-off. I envision the S&P's breaching the 1800 level in the high 1700s. Again, I don't think it's anything other than a healthy correction. Again, if you look at the value of the market based on the VIX, it has been held at a very, very low level, and we kind of need that shakeout. That's what makes the markets tradable, is to kind of shake out the weak hands. So back to the original question. Sorry for the long-winded answer. I think that in the short term, we're going to see a nice buying opportunity, which is going to be led by the institutions. And as we start to push those prior high levels and suck back in the retail traders, we're going to see our next leg down, but that won't be for another a week or so out. So I agree with the bullish sentiment in the short term at 72%. I actually agree with that.
Oh, okay. So you're higher for the week as well? Okay.
Yes.
Thank you.
Short answer, higher for the week.
Okay. Thank you. And Todd, what are your thoughts for the week?
Well, let's see. Can I screen share on my end? Is that possible?
Yeah. Yeah. On the left, there's a little green button near the top for screen share.
Okay. All right. Perfect. I use Google for everything, but believe it or not, I've never used Google Hangouts, so this is kind of exciting. Let me just go. How about? I guess that's going to be number 3. Screen 4. I'll just do up on 4. So, it's interesting. I had one answer ready to go on that, and then kind of looking back at the history of this report, I actually changed my mind here in the last couple minutes. So if you look at your two other highest readings, let me just set myself up, and you guys should be able to see an SPX chart here in a second. It's actually pretty interesting in terms of timing. If you go to, let me just get myself organized here on one monitor. The two biggest readings that I've seen in the history report, I saw June 30th. I think I saw a 68% bullish reading. And tell me if I'm reading this correctly. Or actually, there's a 70.8. So that would have been your second highest, correct? Do you know those numbers offhand?
Yeah. Yeah, back in June, I think, was the second
Yeah.
highest. There was
Yeah.
two. Well, let's see.
I think I just eyeballed it, and it's very interesting. So it seems that there's two indications of your highest two readings, 70.8%, and then there was another 69.8. So that's pretty high there. And June 30th and July 7th.
Yeah, those two right in a row were the highest previous.
So I just kind of mapped that out. So there's June 30th, and then June 7th is right here. And of course, this is the summer, so you got to take that with a grain of salt there through July. But it preceded the actual sell-off by about 3 weeks. And then the other significant reading that I saw, actually the exact same thing happened, which was November 2013, but again going into a holiday period, which this wasn't such an extreme sell-off, but heading into December, it looked like on the November 18th of 2013 reading, I think you had a 68%, which was pretty high as well. So you had a 68.8, which preceded the actual sell-off by about 2 to 3 weeks. So that's kind of interesting, and that's going to play into my response. And I just saw another 69% in there. So that one we already did.
February 10th.
February 10th. There it is. Okay, let's just take a look at that quick. February 10th. Okay, so that one was just spot on. So that was a good call there. The crowd absolutely grabbed that rally. So 2 out of 3 have preceded a sell-off that I would see material, which was about 50 points in the S&P by about 2 weeks. So that's kind of interesting. It's a good point that's being made about the VIX. I am a big Elliott and Fib guy. I love looking at what the price patterns are, because I think with Elliott and Fib, it actually tells you what's the psychology behind the retail as well as the institutional investors collectively. What I would say is, I've traded for an institution. I've got a lot of friends who trade for institutions, and I would always just tell the retail guy, don't feel bad that you're a retail trader. I know a lot of retail traders, and I know a lot of institutional traders, and just because you trade for an institution does not mean you're a good trader. I've seen a lot of bank traders, guys at banks and guys at funds who couldn't trade their way out of a paper bag. So just because you're retail does not mean you're at a disadvantage, and in fact, I think you're at an advantage doing that, because the tools that we have in today's markets are just as good as the tools they have. The information flow they get, half of it's true, half of it's not. So that being said, I feel like I am looking at this, for those of you who are Elliott guys. This is what they call a B wave. We are coming up against a key 786 retracement from that that September 19th to the October low. 786 is at 1976. So I am a little unsure exactly if it's just the A wave that's going to give us that little 50-point decline, but then I do think this B wave will cap us out between 2000 and 2050, which then sets in a C wave decline. So my thesis is we are lower from either right now, or we're going to have one more push up back towards 2000, then into the end of the year we should see selling. So based on that high, typically it's about 2 to 3 week lag time, actually lead time, I should say, to the sell-off. So that actually is going to make me put this B wave here, one more C wave rally from the 2000 level, and then we go into a sell-off into the end of the year. So for this week, I am neutral to higher based on just the analysis that we saw from your report.
Oh, okay. Okay. Yeah. Thank you.
Should I send the screen back over, or how do I undo it?
If you
Just uncheck.
yeah, if you go back to the screen, there
Yep.
should be a band at the top that says
Oh, got
stop.
it. Perfect.
So,
Awesome. Thanks.
okay. So let's see. So you would say higher too for the week then?
Yeah, I'm very, very cautiously
Yes.
bullish for now. The one thing that I did want to say is if you guys just take and I thought this action in the bond market was very interesting overnight. If you take a look at a 24-hour bond chart in the Globex, bonds are settling into this 141.5 kind of low area. Bonds did not break through to new lows in the overnight session while the stock index futures did. And we're starting to see that divergence that happened the last 24 hours start to undo. So if bonds can't continue lower, because bonds and stocks are trading with a very good inverse relationship right now, which was not the case prior to September, but stocks and bonds trading versus stocks broke higher, bonds did not break lower. While bonds are above 141.5, I am a little bit cautious. So and I don't want to sound ambiguous. I'm ready to be bearish in a second. I mean, I'm absolutely ready to be bearish against that 1976 level in the S&P, but I want to see us trade that first. So if it takes the rest of the week to trade 1976, then fine. So I hope that makes sense.
Oh, okay. Yeah. Thank you. So moving on with the next part of the report, question 3 asks people to rate their confidence. So rate your confidence in your question. Rate your confidence in your answer to question 2 on a scale of 0 to 10, with 0 being no confidence and 10 being extremely confident. The average of all guesses, or all forecast responses this week was exactly 6. The average for higher guesses was 5.941. The average for lower guesses was 6.154, so with a slight edge to the lower guesses, even though we had a very strong bullish sentiment overall. So, Greg, let's start with you. You said higher for the week. What would you rate your confidence at for that?
Right. You know, it's I guess similar to the numbers that you're bringing in. It's that's always the big question, right? Are we reversing or are we just pulling back? So I'm fairly confident because markets have always do this. They'll sell off and then they'll consolidate, regroup, and you don't really see a major sell-off until you retest a material level. Kind of what Todd was saying earlier with his wave theory. We sort of need to go back up and hit those levels. So I'm fairly confident that we're going to see that bounce this week. I'd place my confidence level closer to an 8 out of 10. But I wouldn't go higher than that because I believe that there are some, bigger, more global geopolitical influences in the market right now, as there always are. But I think there's just a little bit of a, you can sense a little bit more skittishness. And I go back to the reason why I say that is that incredibly quick spike in the VIX told us that, we didn't climb our way from 16 to 32. We aggressively spiked, which tells you that if you're watching just the slope on that VIX chart, that there is a little bit of greater fear in the market. So yes, bullish 8 out of 10 for this week, and I wouldn't go higher than an 8 level for that reading. You can just sense that underlying tone of a little bit of a greater fear component.
Oh, okay. And Todd, what would you rate your confidence at?
Yeah, I fully agree with what Greg's saying in terms of this VIX. We just saw a pretty healthy spike in the VIX up to 31, 32 area. This, and I'm going to circle back to I just want to kind of continue on to Greg's point. We saw a move up to 31, 32 in the VIX, and we've had, I think, a 10% decline. The last time we saw any kind of meaningful correction in the S&P was in 2011, the summer 2011. We saw like a actually it was 20% decline. 48. So far, we have a VIX of 31, and we have a 9.5% decline, give or take. So we are halfway there in terms of a real correction. the timing of this week, I think we're both a little unsure. There is a significant down move coming. We just don't know if it's up from another 10 handles or so in the S&P. So I am very low in terms of my conviction of going higher. I am not long, and in fact, I'm just starting to sell calls above the mark with clients. So I have very low conviction. I'm not going to be trading at the long side, though. I'm not going to be surprised at all, but we are going to be moving lower. The other thing in terms of volatility, Greg's talking about it a lot. I mean, we just saw the biggest bond move. I mean, I don't have data that goes back any further, but that was the biggest bond move I think we've ever seen. And tell me if I'm wrong, but we didn't see a bond move that big on the 15th around September 11th, 2001. I mean, that was massive bond move. And I actually got pulled apart on that. Believe it or not, I was short iron condors, which is a short volatility play in TLT, so I kind of got crushed on that trade. But, hey, that happens in trading. I just don't think you see that kind of volatility move towards higher bonds, higher VIX, and especially when you put it in the context of any kind of meaningful correction we've seen in the past. We're only halfway there. Granted, that was at the beginning of the European credit crisis in 2011. U.S. got downgraded. We don't have that kind of fundamental situation, but from a technical level, price action point of view, we're way overdue for a correction, and the market will grasp onto anything to get that correction it needs. So my conviction in the next week is very low because I do think we are heading lower several weeks out.
Okay. Do you wanna put a number out there?
Oh yes, sorry. What's the average? Average for all guests is 6. Higher 5.9. I will say, how about 2.618 is my number.
Okay. All right. Perfect. Thank you. Thank you. Yeah, that actually that reminds me too. What you said. I get a lot of people that write in and say to add a neutral answer for question 2.
Yeah.
But the reason I haven't is, well, I mean, it's never going to be exactly neutral. So I'd have to define a range. Like, I mean, what is neutral? Is it less than 0.5%, or is it less than a 1% move, or less than 0.25%? And as volatility changes, that changes over time too. So I'd have to, change it in some way. But that's what I think the most important part of the confidence rating is you have to pick one or the other, higher or lower. All the respondents have to pick one or the other. But then if you think that it's, like you said, if you're neutral on it or almost neutral, or you think it's going to be moving soon in the opposite direction, then you guess lower on the confidence than you otherwise would. So
yeah, that's interesting.
But I'd mention that. So moving on with the report here. The bottom of page 1 always shows a graphical representation of the full history of the survey, and then page 2 shows the full numerical history, and then page 3 starts with the open-ended questions. So question 1 is the same each week. What developing events, technical or fundamental, will you be watching out for next week that might have a positive or negative impact on the S&P 500 and other markets? Mm-hmm. So if you download the report, you can look through everyone's comments there. A lot of mentions about Ebola and Fed and terrorist attacks and that sort of thing. So let's start again with Greg. Do you have anything else you're watching for this week that might happen?
Well, from a fundamental perspective, watching the European banks. We had 5 banks that failed the stress test last week, and that's material. That's something that if you go back to the crisis in 2008, that's where most of it began, with banks failing their stress test. So that's certainly something to watch. Sorry, the dog's about to bark. On a fundamental basis, that's what I'm looking at. On a geopolitical, outside events, obviously the terror threats can really derail the markets quickly. I agree with Todd. We're headed for some selling in the next few weeks, and that can be dramatically accelerated if we see another event like we saw that last week. And from a purely technical perspective, again, I go back to the VIX, which is really on my radar screen right now, and I'm going to be watching the movements very carefully and seeing what the correlation is between the market, because the VIX is the VIX is the only indicator that is predicated on trader sentiment. Everything else is based on pure numbers, but because they're bidding up the implied volatility, we can extrapolate from that what the actual sentiment is before the move happens. So it's the one indicator that allows you to a little bit of projection outwards. So I'm watching at I guess the sensitivity between the market move and the move in the VIX, the correlation between the two. So that would be on the technical end.
Oh, okay, sounds good. And Todd, do you have anything else you're watching for this week?
Yeah, and actually I had a question for Greg. In terms of the VIX, didn't they just start including the weekly options in that calculation? Has that taken place yet?
No, I don't believe it's in yet. They're talking about it, but I don't think it is. Yeah, it's
Okay.
a good question though, because about 8-9 years ago we saw them go from one type of VIX calculation to another when it was originally based on the 20 odd.
yes. Yeah.
And then they went to include all the options. So I don't, as far as I know, they haven't included them yet. But it's definitely going to be something to watch, and it may require a little bit of backwards adjusting to see what the new moves in the VIX look like versus how sensitive it was prior to that.
Yeah, that's interesting, because they're going to start including the weeklies, and the weekly options they didn't think would get any volume, but they're coming in, so that's interesting. The one thing I think is going to have an impact here is energy. We are coming into some energy earnings, and let me just figure out which screen I'm going to share. How about number? Oh, I'm hoping that's correct for number 4. Energy has been a real mover, very volatile. You guys should be able to see a sector overlay chart, hopefully. Maybe about 12 sectors overlay, percent change. Is that the screen I'm sharing?
Mm-hmm.
Okay,
yeah.
Perfect. So energy has really gotten wrecked. Energy is down from that September high. Actually, I should do a percent change from the actual stock market high. Percent change from this bar. So energy is down it's down 11.48%, where all other sectors are roughly half of that. So we have utilities at the highs. We have staples at the highs, and the dark one that you can barely see is healthcare, and then home builders. So looking at that, and I'll circle back to energy here in a second. You've got staples, utilities, home builders. I mean, those are all defensive sectors that are leading the way right now. I mean, on this recovery back, and energy is at the absolute lows. So we've got some earnings coming out, and then if you look at the sector performance here today, energy's getting wrecked. I'm short crude. I'm short a 32.5, 33.5 USO call spread. It's a fourth wave consolidation looking to break down. I think crude's going to get down to 75, and I think if energy continues to let me scroll down here. If energy continues to underperform, I mean, look at these today. I mean, Halliburton's on 6.7%, EOG, Schlumberger 4.7. I mean, these guys are really getting hammered. So if energy wants to continue to move lower, I think crude gets 75, and then I still think that is this disinflation/deflation event. Energy goes down, the dollar continues to strengthen, and there is a long-standing inverse relationship between the U.S. dollar and the stock market. So from the energy point of view, I think that's a major concern that would bid up the dollar. And also, energy falling is, again, disinflationary, deflationary, which is bullish for bonds against that 141.5 level in the 30-year that I talked to you about. And I think that ultimately is what will get stocks to roll over. So my biggest concern is energy.
Okay. Okay. Thank you.
Sure. Let me send that screen back to you.
So then, moving on with the report here, question 4 of the report is different each week. So for this week, the question was: Johnson & Johnson, GlaxoSmithKline, and other corporations are racing to develop and distribute Ebola vaccines. do you think these vaccines will be effective enough and be ready in time to help stop the spread of infection? And do you think the vaccine will be profitable for these companies? So I went through and quantified everyone's responses. And for the first part of the question, do you think these vaccines will be effective enough? 44.4% said yes. 55.6% said no. For the second question, do you think these vaccines will be profitable? 54.5% said yes. 45.5% said no. And I was kind of reluctant to ask about Ebola because that's not well. But a lot of people wrote in and asked me to ask a question about it, so I didn't want to be part of the media hype about Ebola. But a lot of people, like I said, a lot of people asked me about it. So let's start with you again, Greg. Do you have any thoughts about this?
Yeah, well, first of all, I'm certainly not in the pharmacology area, and I couldn't tell you whether or not they're going to be able to come out with the vaccines or whether they're going to be profitable. What I can say is, in my own opinion, we don't have. I don't think that the Ebola situation is as dire as it's being made in the media. Like you pointed out, it's media hype.
Yeah.
And they're very quick to jump on the new cases. But you take as an example the young nurse in Texas who recovered. It certainly didn't make the media afterwards, right? They went on to find somebody else who was infected in New York, and they kind of left the whole story about the nurse who recovered fully. If you look at the recovery rates outside of North America, Ebola is very scary, and it's a concern. I still don't think it's an epidemic at that level. I think it's a lack of proper control of the spread of the disease. And if you look at the recovery rates in North America, people are dying from every other disease out there at far greater rates than Ebola. So I think there's a lot of media hype here, and I think that the whole Ebola scare situation will be behind us within a couple of months, and I don't think that if the vaccines do come to market, I don't think it's going to have a material impact on the company's bottom lines, and I think that once we stop talking about it in the media, it will be quickly forgotten. That's what I think, that's what I hope, and hopefully I'm right and it doesn't spread and become worse.
Yeah. Okay. And Todd, did you have any thoughts about this?
Yeah. I guess I got to qualify this. I am under contract with NBC for CNBC, and I've been for a while. And I'm not defending them and/or any other major media outlet, but I actually think, just talking about the inner workings of the market, I actually think it's a little unfair to blame the media, because remember, the media only puts out content that viewers demand. They only sell content that viewers demand, and I think because we're at such an elevated stock market point, viewers are demanding a reason to begin taking profits on long positions. They're looking for anything. So I think it's the people's demand that then puts it in it's the market participants' demand that puts it out there. So that being said, the markets are going to grasp onto anything to begin taking profits. In terms of how it impacts, again, I'm not an expert in this field in any shape or form. I did actually have the opportunity to talk to a leading cardiologist this weekend. I went to one of my son's friends' birthday parties, and he was just saying, responsibility can go a long way. There's doctors out there doing wonderful things. This gentleman who's 31, 32 years old in Guinea, coming back, and then he goes out and plays he bowls, and he goes out and does a whole bunch of things. You say a little common sense for these doctors doing wonderful things, going overseas, coming back. I mean, he goes, these things can be very easily contained. For people going overseas, I mean, there needs to be some kind of containment, and I think the U.S. is very much on top of this to prevent the spread. I mean, containment, a little common sense is going to go a long way. So I don't believe it will be. It'll become widespread. Hopefully, Lord willing, it won't. But again, we are bullish. Greg and I both come away with a bullish outlook for the rest of the year. So markets are going to grab on anything they can for a reason to fulfill that need to hit the eject button and take profits and succumb to their greed emotions, which do make markets sell off. So I hope that helps.
Okay. Yeah. Thank you. And we did have one question too during the show. It's a bit off topic from what we were talking about, but someone asked, what are the best Forex markets to trade and what are the worst? Do either of you have any thoughts about those?
I used to trade for an FX hedge fund, so I could probably help you with that.
Go ahead.
In terms of what markets, like, are you talking about, and I probably need a qualifier, which specific currency pairs are best to trade, or which vehicle, meaning the spot Forex markets, the futures, the ETFs, maybe a qualifier there.
Yeah, the person just said what are the best Forex markets to trade, so I assume they're talking about currency pairs.
Yeah, sure. I'll hit this real quick. I think the best currency to be trading right now is the yen. The yen is the market that responds the best to deflationary/disinflationary forces out there, and when stocks do and eventually move lower, bonds find a low, energy's moving lower, the dollar strengthens. Those are all deflationary forces, and the yen tends to benefit the most. So long FXY positions, short anything XXX/JPY if you're trading the spot Forex market. So when stocks do roll over, the yen is the market that responds most to rise in volatility. We have the Fed coming up Wednesday. We'll see where they are. I think they're going to be a lot more dovish in terms of what's going on. There's a lot more volatility out there. There's a lot of unknowns. I don't think the Fed is in any position to begin raising rates, and they still have a $4+ trillion Fed balance sheet. So there's tons of liquidity out there in the system. When the Fed does finally look to raise rates, that would be the time to be long and bullish the dollar. But right now, those forces that are weakening the U.S. dollar are still very much out there. So the dollar, in my opinion, remains a little bit more of a tricky trade. But when things do get better, fundamental picture looks better, the long dollar trade is the way to go, but not right now.
Okay. And did you have any thoughts about Forex, Greg?
Well, I just think the question needs to be expanded on a little bit. What time of day do you want to trade? Are you a day trader? Or are you a swing trader? Or are you looking to put on position trades? For me, being in the day trading environment, first question to answer is when do you trade? Because if you don't want to trade, 8:30 p.m. Eastern time until 2 a.m., then the yen's a difficult market to trade because that's when it's active. So I always gravitate to the markets that are the most active and have the most institutional activity at the time of day when I want to trade. So if you want to trade early in the morning, 5, 6 a.m. Eastern time, the euro is a great market. If you want to trade at 2 p.m. in the afternoon, then really none of the Forex markets are active at that time. So I need a little bit more information on that.
Okay, I actually just had another question come in here. Is there a VIX? I'm just going to read this. Is there a VIX to measure bond market psychology, like the S&P 500 and VIX? What to use to measure investor psychology in bond markets? Does such a product exist? So, a VIX for bond markets, basically, is what they're asking. Is there some kind of equivalent?
Do you want to take this one, Greg, or do you want me to take a shot?
Yeah, I'm not familiar with any, so if you know the product, then go ahead.
I was just going to say, why don't you just look at, we just look at implied volatility and historical volatility. Just look at the volatility ranges for the bond markets. You can do it on the TLT or the bond market itself, and I mean that's here. Just to give you an example. Let's do this.
I agree with you. The easiest thing to do is just to do an overlay by implied and historical volatility. I guess the issue would be bringing in a couple of products to try to get, not just the bonds, but try to get a couple of instruments in there to cover the spectrum somewhat.
I'm just trying to pull up a chart for you. Yeah, basically, I was just going to show you a chart that, Greg's right, you got to get a couple different products in there. But, TLT, I think it's just a combination of 10s and 30s. You can just do implied volatility and historical volatility. If you do an implied volatility of all options in the SPX and put it below the VIX, it's almost the same. It looks very similar, so you could just look at implied volatility. And I do know for TLT right now, it's in the top half of its range. A nice little indicator I use over at Thinkorswim is this implied volatility percentile. It just basically ranks, where implied volatility is relative to recent ranges. And right now, I think it's like 53%. So it's in the top half of its 12-month range. So for options traders, that means volatility is a little bit more expensive. Right now, implied volatility for TLT is 14%. Historical is 11%. We are in a range anywhere from 10 to 12% implied volatility. Right now, we're at 14. We were up as high as 20%. So implied volatility is high right now. So if you are trading TLT, I still think a good opportunity is to be short implied volatility, short premium in this kind of higher environment. But just kind of a simple answer for you.
Oh, okay. Sounds good. And I guess we are about out of time for today's show. But going back to the report too, I want to mention that if anyone watching has a suggestion for a future question for question 4 of the survey, just go to TimingResearch.com/question and submit your idea there. And to download this week or any week's report, just go to TimingResearch.com/reports. And be sure to go to TimingResearch.com/current survey to fill out this week's survey for the coming report next weekend. So I want to thank both my guests, Greg Weitzman of TheTradingZone.com and Todd Gordon of TradingAnalysis.com. So thanks, guys, for being here.
Thanks, guys. My pleasure. I really enjoyed it.
All right.
Thanks, everybody.
All right. See you next time.
Catch you in the next one. Bye-bye.
Bye.
All right. See you guys.